Welcome back to the Noob Selling Options channel, everyone, and a really special welcome to our NSO AI Fortress and Crypto community. Today, we're bringing you an exclusive explainer on some pretty advanced defensive mechanics. If you've been watching the markets lately, you know things have been completely wild. And honestly, managing risk, that's what separates the absolute pros from everyone else. So we're going to break down exactly how to protect your portfolio when the market throws a massive curveball right at your head. Okay, let's dive right into this situation. We're looking at yesterday's action, where SNDK absolutely blasted through its all-time highs. Now, this kind of explosive parabolic movement meant we had to execute an emergency, but still highly systematic defense on our short strangle. It's exactly the type of scenario where, honestly, most retail traders just freeze up. But as you'll see, having a mechanical plan changes the whole game. To understand why we had to act, we first got to understand the threat, right? When SNDK surged past $1,250, with Wall Street analysts suddenly throwing out these massive $1,700 price targets out of nowhere, our February 1650 short call faced immense gamma risk. Gamma risk is that rapid, super dangerous increase in negative delta when your short call gets heavily tested by a parabolic stock breakout. It's that exact mathematical pressure that usually triggers widespread retail panic. Here is our agenda for this explainer. 1. The SNDK emergency. 2. Executing trade mechanics. 3. The math breakdown. 4. Trading psychology. And 5. Preparing for future rolls. Let's just get right into it. Starting with Section 1, the SNDK emergency, parabolic runs, and tested positions. Because of that crazy upward move we just talked about, our overall strangle became dangerously short. As SNDK aggressively pushed toward our 1650 strike, the directional risk just skyrocketed. But instead of freezing like a deer in headlights or, panic buying to cover, we needed to neutralize this risk and basically buy ourselves time for the inevitable mean reversion. Moving right along to Section 2, executing the trade mechanics, systematic multi-leg adjustments. When we pull up the actual receipts from our May 4th trade log, it becomes incredibly clear how a classic, systematic strangle defense actually operates. We took the untested side, which was our put, and rolled it further out in time to collect premium. Then we took that exact premium and used it to finance rolling our deeply tested call up to a much safer strike. This brilliantly illustrates our dual action strategy. On the put side, we're harvesting time value premium by extending our untested 550 put from September out to December, which gave us a massive credit. Meanwhile, on the call side, we bought back that dangerous February 1650 call and sold the February 1730 call for a debit. The real beauty of this maneuver is that extending the put completely covered the really expensive cost of defending that call. Let's hit Section 3, the math breakdown, financing defense without out-of-pocket costs. Let's look at the actual numbers, because I want you to see exactly why this beats the typical retail panic response. We received $33,990 in total premium, and we paid $33,121 to buy back our previous positions. That leaves us a gross credit of $869. Subtract a tiny $3.61 in commissions, and we are left with a positive net cash flow of exactly $865.39. So, here is the absolutely crucial point. If we had just defended the call by itself, it would have cost us $1,784 in capital straight out of pocket. Instead, by utilizing the untested put side, this maneuver didn't cost us a single dime. Actually, scratch that. The market literally paid us over $865 to fix our own trade. How cool is that? And even better than the cash flow, we bought ourselves 80 extra points of upside breathing room. By moving that short call from 1650 up to 1730, we pushed our risk horizon further away, giving volatility crush and time decay way more runway to work in our favor. All right, Section 4, mindset and trading psychology, emotional detachment in a financial fortress. Because trading isn't just math, is it? It's an intensely mental game. By refusing to take a massive realized loss, we protected our 21% compounding curve. Remember, a severe drawdown means you need huge future gains just to get back to zero. This shows we maintain high conviction in our mega-cap tech thesis. We aren't scared of the asset. We're simply managing the short-term math. System over emotion every single time. Which brings us right to Section 5, preparing for future rolls, the 2 steps ahead battle plan. A veteran trader is always looking ahead, right? When a stock goes totally parabolic, option chains often lag behind the actual price action. So right now, patience is key. We are going to wait for market makers to open the 1800 strike. Once it appears, we'll roll our call towards it. And, crucially, we're going to hard cap the put side at the December 600 strike. We have to let the market come to us so we don't force a bad adjustment. Now, why hard cap that put at 600? To avoid the whipsaw trap. When a stock is just ripping higher, the temptation is to keep rolling the put up aggressively for huge credits. But if the stock violently mean reverts and tanks, that high strike put suddenly becomes deeply in the money. Capping it at 600 strictly controls our risk if we get a sudden pullback.
Yes, capping the put means we definitely leave some premium on the table, but it stops a winning side from turning into a massive liability. Protecting the base with this kind of disciplined capital management is exactly how we keep our engine running toward that $888,888 milestone by 2032.
So, I want you to think about this as you plan your next trade. Are you trading with emotion, or are you building that AI fortress mentality? I really hope this explainer showed you the true power of systematic defense. If you found this breakdown valuable, hit that like button, and please subscribe to the Noob Selling Options channel so we can keep building your financial fortress together. Catch you on the next one.